Wondering what to pay yourself in director's salary? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And as you can imagine, at this time of year, we talk a lot to these owners about what their salary from the business should be. So I thought it'd be a great time to do a video on the 25-26 tax year. So before we get into this, if you like these type of videos, be sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. Okay, so firstly, let's talk about the type of owner I'm discussing in this video. It's very important. I'm talking about your typical UK small business owner who both runs and owns their own limited company business. So you're the shareholder and the director. If this is you, it's likely that in order to pay yourself in the most tax efficient way, you're going to want to pay yourself in a combination of like a small salary and plus the rest in dividends. That's the payment of profit. So it's these dividends from the profit. Now, there are many good reasons for paying yourself this way, which I'm going to show you in a second detail. I'm actually going to bring up a bit of a sheet, shock horror, and show you that. In summary though, the overall tax saving achieved in doing it this way is a combination actually of corporation tax, national insurance and personal tax savings is a combo of the three, and I'll show you it in detail. Of course, your aim will be to pay as little overall tax as legally possible, and right now it's likely that you pay a little of all three of those types of tax in order to achieve that. So let me show you a quick recap of this in practice so that you just understand the main concepts. And I know that, as I said, a shock horror accountant wants to talk through a spreadsheet, but I'm just going to show you it so you can see. So hey ho. But this spreadsheet you can see here shows a few scenarios. And in this scenario, we're going to presume that you're the only employee, so something known as employment allowance isn't available, and that your pay from the company is your only income. We did another video on employment allowance if you're interested in that. So the first scenario is in the right-hand column, which shows what happens if you took all of your company's money out that you wanted to get paid, like all of the money, all of the profit in just dividends. And you can see we've got sales there of 70 odd grand, less some expenses, and a corporate tax bill at 25%. Now, quick caveat, you wouldn't likely pay exactly 25% here, just due to the way the corporation tax work. But to keep the example simple, I just wanted to keep it kind of worst case. So this would leave you with about 45k to take out as dividends. And at that level, you'd pay around 2.8k in tax, leaving around 42k to kind of take home and enjoy and spend how you wanted. Now, the column on the left gives us the same scenario, but this time you're paying yourself some salary, a small one, and then the rest in dividend. So the first example on the left here, I've shown you a salary of just like 12.5k-ish. And if you look at the highlighted figures for the taxes, you can see where we're actually paying some national insurance where we weren't before, but the salary has given us a large reduction in that corporation tax bill. And this has meant we're about 2k-ish better off when all the various taxes are considered and paid. I mean, I'm going to come back to this later and show you what happens with the different salary levels you can see, but I just wanted to recap you on why you generally don't just pay it all in dividends, because I think one of the follow-up questions is quite often, well, what happens if I just pay it all in salary? And I'm going to show you if I just loaded more salary on there, what would happen, but I'll show you that in a bit. However, there are definitely scenarios where paying all dividends is actually the best choice, but when all of your income is from the company, it rarely is. So then you're going to ask, what is the best level of salary for 25-26? Well, let's get the standard accountancy answer out of the way, shall we? It depends. The true answer to this question is very specific in that it's just so down to your individual circumstances, your business goals, your personal goals, whether you need a mortgage, where you are with your business, loads of stuff. So you should seek specific advice around that with somebody that knows all of those things and have a good chat, and you can come to an actual decision. But with kind of the official disclaimer answer out of the way, let's look at the most common scenario, because in a lot of cases you see the same sort of things. Now, for many small business owners, where your business is your only source of income, you would generally look to set that annual salary in the 25-26 tax year at either just over 6.5k a year, and I'll explain why, or very commonly you're going to see 12,570 per year, which is in line with your personal allowance that you as an individual in the UK can normally earn tax-free. And that's the example I've just shown you. Now, all these levels with no other income, you'd pay no income tax or personal national insurance. Then, as I showed you earlier, you would then top up your pay by paying dividends to yourself. And these dividends are national insurance free, but still have some income or personal tax, as most people often refer to it as, and that tax will be due on them, and you'll sort those out in your tax return later. Now, the rates vary, but if your dividend and your salary combined under about 50k a year, you'll pay just 8.75% on those dividends. So they're pretty attractive versus maybe like 20% on your salary. However, there's other factors we'll see in those spreadsheet examples, you can kind of see it in play. But there is also a small £500 only a year dividend allowance. It means the first £500 of dividends is tax-free. It's pretty sad. It used to be £2,000, and there's even better historical kind of rates and situations around dividends. We're just in the sad place where it's slowly been eroded. And then the sad news on that is when you creep over the sort of 50k combined income-ish levels, the dividend rate jumps to just over 33%. That's a pretty big jump, right? And it does start to sting. So there's a lot of planning goes involved with, when you get to that level, making sure that you're doing it in the right way to kind of minimize that bill. Now, all of this tax bill was sorted out in your personal tax return, as I said. So if you don't already do one, you've got to think, actually, yeah, I'm going to need to complete a tax return this year. Now, the good news in all of this is that the salary itself, that bit that you're paying, whether it's 6.5k or 12.5k-ish, is corporation tax deductible in the limited company. So you're saving somewhere between about 1,200 quid and about well over £3,000 in just corporation tax, depending on the rate that you're paying in the company. So then the next natural question would be, well, why these two values then? Where have they come from? So let's start with the lower one, the 6.5k level. Now, this lower amount isn't exactly strictly the tax efficient number, but when you're paid more than about 6.5k a year, you exceed what's known as the lower earnings threshold for national insurance. And that means you'll get a state pension qualifying year. It's kind of a tick in the box for that year. And it's something that's very important to you if you're worried about the amount of state pension you're going to get when the time comes. Hopefully, most of us will live long enough to see that. And as you need it around 35 of these ticks in the boxes, these qualifying years, to get your maximum pension, it's going to be really important. And an important point to remember here is that 6.5k needs to come from one source in order to get the pension for that year, and it needs to exceed it, and that's quite important. So if you pay monthly, you might decide, for example, to make sure that you're paying above it. So you might pay like £6,116 or something to make sure on a monthly figure you're going over that threshold, because you wouldn't want to get to the end of the year and realise that you've underpaid yourself by £1 and just missed this qualifying year that you want, and it's more common than you would think. So in terms of why you would use this over, say, the 12.5k version we've already seen, is that you'd normally do it when you have other income that uses up some or maybe even all of your personal allowance. Say you have like a part-time job, you've got a side hustle on the go, or you've got like a rental property, but you still care about this pension qualifying year. If you don't care about the pension year, you might make a different decision. But at this level, you get the pension year, but you're not paying any more national insurance than you need to, because you will be paying some. However, for many owners, with the business being their sole income, that 12.5k level is really good use of their personal allowance, and it gives them then the full corporation tax deduction using that allowance without paying any more national insurance personally or any more of the company's contribution than is absolutely necessary. So for example, if you paid more salary than the 12,570, whilst the company would absolutely get a further tax deduction, you would pay personal national insurance and the company would have further national insurance to pay. Now, there is something known as Employment Allowance, which can cover much or all of that employer's national insurance, but you'd need to qualify. Not only would you need to qualify, you'd also need to make sure that it wasn't all used because your team was so big and then it was just costing you more money anyway. And you absolutely won't qualify if you're the only person on the payroll, which was the example I was showing you. Now, you'll have to watch our other video on that if you're interested in the relief for all the details, because there's some criteria around that. And I think we're going to update that soon as well, because there's been some changes. So let me just show you an example with slightly more salary so you can see what happens to the various taxes and how the tax saving looks. So let's take a 25k salary this time and have the rest in dividends. Now you can see the tax saving is down to only around 1,200 odd quid. It's not a lot compared to where it was. And if I keep increasing the salary, it just gets worse and worse until there just isn't a saving. It's actually going to minus on this spreadsheet. You would just see that the national insurance and the personal taxes begin to outweigh the extra corporation tax saving you have. And that's why people don't generally pay all salary. But there can be reasons, as I'll touch on later, why you might again, but just generally you don't see it very commonly. So it's probably a good time then to touch on where the general scenario doesn't work. So I thought we've talked about the general one, but let's talk about the obvious scenarios where actually you might want to take it back to a spreadsheet and have a look. Where does it make sense not to do this kind of thing? And I think it comes down to a few different choices. Firstly, if you have other income above 12.5k-ish from other sources, so you're full-time employed, you've been paid 40 odd grand, that kind of thing. If you're claiming research and development tax credits for the company, you've definitely got to think about that salary level. If you have a mortgage you want to obtain and you're relatively new in business, it's a real consideration for you, because sometimes dividend income can be hard to prove in those early years. So bear that in mind. That's worth definitely looking at. And if your company for some reason couldn't end up paying dividends in general, let's say there wasn't enough profits on paper, or you had another shareholder involved, or your structure didn't allow it, then you're back to the drawing board with what salary you pay. And finally, I think If you're earning over about 100K, you definitely want to have a look at different options that you could do to make sure that actually paying any salary is worth it, because you'll start to lose personal allowances and things like that. But again, that's going to be back to the spreadsheet. Have a look at your options. And of course, it would be a very long video if we attempted to try and cover all of the various scenarios. But I just wanted to give you some obvious pointers when those scenarios, it's like, look, you definitely want to think about it here. The most common one there being you've already got an employed job and this is your side hustle. Now, to really crank the tax efficiency up in some of those situations and in general, I want to mention a couple of potential opportunities to save even more tax. So if you have any of the following, there are likely to be further tax plan and potential opportunities of how you might structure you drawing money from the company. And there's probably an entire video we could do on that just on its own. But just to give you some little tidbits towards the end of this video, a large director's loan account, if you've got one of those where the company owes you a lot of money you had to put in, there might be a chance to charge tax efficient interest. Just putting that one in your head. There's some very practical problems with it, but from a tax efficiency point of view, it could be quite good. If your office is based at home and you've got the right paperwork in place, there might be a scenario, if it makes sense, where you can charge your company rent for a sort of non-exclusive use of that room. And then finally, the third one I want to touch on is if you want to pay into a pension. There is often a really, really, really tax efficient way for a limited company to get your money from that company into your own pension. Finally, if this is not the first year of you paying yourself salary, I want to remind you that there's a little more hassle this year. We've seen the various taxes in play, and with the tax changes from April 2025, at these salary levels, it's likely your company's going to need to pay over funds to the revenue quite often in respect of national insurance contributions at the minimum, if not tax. Now, there are two ways this might work in terms of when you'll be asked to pay. And again, we could probably do another video just on that, but you've got a couple of options. So in short, you could be asked to pay it monthly, and some people might choose that, or there's another basis you can pick, which means that it's actually kind of rear-loaded, so you'll pay it towards the end of the year. I think from a preference point of view, we quite often like the end of the year, just in case anything changes, but it depends how you process your payroll. If you're doing it annually, if you're doing it monthly, if you've got somebody doing the payroll for you, have a discussion about that. Now, the reason I mention this is that if you've been in business for some time and you're receiving that kind of tax efficient salary, you might just never have had to do it before. And that could just be a surprising thing. Why is this bill? Why is this happening? It never happened before. So it's just something to be aware of. So your action point from this entire video is go and review that salary, reach out to a professional if you need some help, but just see where you might lie. And if you're in any of those weird scenarios, just make sure that you've gone to a spreadsheet and checked. I mean, there's a lot of online tools, but ultimately a spreadsheet, if you're bored, can also help come to that answer. And that's it. So if you've enjoyed this video, please do click on the subscribe button and the bell below and share this with anybody that you think needs to know this information. If you've got any questions, I'll do my best to answer them in the comments below, and I'll see you in the next one.